No worry, Alex. It might sound a bit technical, but trust me, it is super duper useful for understanding how quickly, how fast you are selling your stuff, your products, and whether you are managing your inventory effectively, efficiently. The formula looks like this. Inventory turnover equals cost of goods sold, COGS for short, divided by the average merchandise inventory. All right. Let's break it down. The cost of goods sold, the cost of goods sold, COGS for short. This is the total of the products you sold during a period. It includes the cost of materials, cost of labor, and any other expenses associated with producing or acquiring those goods. Give an example. If you sold 100,000 worth of products, right? So let's say give an example, you sold, okay? So 100,000, okay? 100,000 means in money value, okay? In monetary value, 100,000 worth of products, okay? So let's say this is you sold 100,000 worth of products, and let's say it costs you, costs you 60,000. Okay, let's say 60,000. Okay, so that means your COGS. Okay, your COGS. So your COGS will be this one. This will be your COGS, cost of goods sold. Cost of goods sold. All right, simple. Okay, give an example. If you sold 100,000 worth of products, and let's say it costs you 60,000 to make or buy them, your COGS is 60,000. Simple. Okay. On the other hand, average merchandise inventory. This is the average value of your inventory during a period. Okay, during the period. You calculate it by adding your beginning. Beginning means the opening of your inventory, and ending. Ending means the closing of your inventory, and dividing by 2. All right, dividing by 2. All right, example. Okay, example. Let's say if you started the year with 20,000. Okay, let me give an example. Okay, for inventory. Now we are talking about the inventory. All right, inventory. So let's say opening as the beginning. Inventory means stock, right? Your product, your stock. Let's say 20,000, okay? 20,000. 20,000 worth of opening, 20,000 worth of beginning inventory, okay? Your opening, your beginning inventory. The unsold goods brought from the previous period, perhaps yesterday, last month, or last year. Balance unsold stock, balance unsold products, unsold goods. You get me? And let's say ended with 30,000 worth of closing inventory. All right, closing, the ending inventory. Let's say 30,000. Opening 20, closing 30. We have these two figures, right? To get the average, merchandise inventory, you need opening value and the closing value. So let's say 20, 30, you get these two. You add them up, you add these two up, and then you divide it by 2. Okay, and then you divide it by 2. To get the average. So 20 plus 30, 50. 50 divided by 2. That means your average inventory, which is equivalent to 25,000, right? 25,000, right? So this is your average merchandise inventory. This will be your average merchandise inventory. So you get this figure, 25,000. Average merchandise inventory, that value as 25,000. Right? Simple. So the inventory turnover ratio is a valuable tool for understanding your business efficiency. By monitoring this metric, right? This metric, inventory turnover, presented in the number of times, you can actually optimize. You can actually indeed optimize your inventory management, improve cash flow, and ultimately boost your bottom line. Trust me. Yes, you need to monitor this metric and monitor closely.